You put money in a bank because you think it's yours. Not emotionally yours, not morally yours, legally yours. And that's where the problem starts. Because buried in financial law, written quietly after the last crisis, is a rule that flips that assumption on its head. A rule that says, in certain conditions, your savings are not protected. They are available. Not stolen, not hacked, not confiscated by the government, reallocated. Tonight, we're going to talk about the hidden law that makes that possible, why it exists, how it works, and why almost nobody talks about it, despite the fact that it directly involves your money. Let's start somewhere uncomfortable. When you deposit money into a bank, it stops being your property. That's not a metaphor. That's not a critique. That's the legal structure. The moment your paycheck hits your account, you're no longer storing cash. You're making an unsecured loan to the bank. You are the lender. The bank is the borrower. And like any borrower, the bank is allowed to use that money. Lend it, invest it, leverage it. This has always been true, but for decades there was an unspoken promise underneath it. If the bank failed, depositors came first. That promise died quietly after 2008. The financial crisis didn't just break banks, it broke a belief that governments would always step in, bail everyone out, and make depositors whole. That belief turned out to be expensive. So regulators did what regulators always do after a disaster. They rewrote the rules. Not in headlines, not in press conferences, in legal language. Here's the shift. Before 2008, the standard rescue model was the bailout. Banks took risks, banks blew up, taxpayers absorbed the loss. Politically, that became radioactive. So a new idea was introduced, the bail-in. A bail-in doesn't use taxpayer money to save a bank. It uses the bank's own creditors. And remember who the largest unsecured creditors are: depositors. This isn't theory, it's law. Across the US, Europe, Canada, the UK, Australia, after the crisis, bank resolution frameworks were updated to explicitly allow bail-ins. The logic was clean, almost elegant. If a bank fails, its losses shouldn't be socialized. They should be absorbed internally, by shareholders first, then bondholders, then if needed, depositors above insured limits. On paper, it sounds responsible. In practice, it changes everything. Because now, in a crisis, your savings are not just protected funds, they are part of the capital stack. Let's make this concrete. Imagine a bank with $100 billion in assets, loans, investments, derivatives. Against that, it has liabilities, deposits, debt, obligations. If asset values fall just a few percent, 3, 4, 5%, the equity evaporates. That's not dramatic, that's math. Banks run on leverage. And when that happens, regulators step in. Not to ask permission, not to hold a vote, to stabilize the system. And stabilization doesn't mean protecting individual savers. It means preventing contagion. And this is where the bail-in mechanism activates. Deposits above the insured threshold, $250,000 in the US, similar ranges elsewhere, can be converted into equity, converted into long-term claims, or simply written down. Your savings don't disappear, they change form. You don't lose money, you lose access, which in a crisis is functionally the same thing. If this sounds abstract, it already happened. In Cyprus in 2013, depositors woke up to find their accounts frozen. Balances above the insurance limit were seized and converted into bank shares in a failed bank. People didn't panic because of rumors, they panicked because the legal framework worked exactly as designed. And that's the point. This isn't a loophole, this isn't corruption, it's not an emergency measure, it's the plan. The uncomfortable part is that this system was sold as safer. Regulators argued that bail-ins would reduce reckless behavior, protect taxpayers, and make banks more resilient. In one narrow sense, that's true, but safety for the system is not the same as safety for the individual. And that distinction matters more than people realize. Because deposit insurance, the thing most people rely on, is not designed for systemic crises. It's designed for isolated failures, one bank at a time, not many at once. If multiple large banks come under stress simultaneously, insurance funds don't scale. They never have. They're backstopped by confidence, and confidence is fragile. This is where the irony creeps in. The more you trust the system blindly, the more exposed you are to its design. Most people think risk lives in stocks, or crypto, or volatile markets, but the largest concentration of financial risk in modern life is sitting still, in cash, inside banks. And that risk doesn't show up as volatility, it shows up as legal priority. If you're under the insured limit, you're told you're safe. Technically, you are, but safety depends on enforcement, liquidity, and political will, not guarantees. And above that limit, you are explicitly a loss absorber. That's not speculation, that's documentation. Now zoom out. Why does this matter right now? Because the global financial system is more leveraged than it was before 2008, because banks hold massive amounts of long-duration assets that were priced for near-zero interest rates. And when rates rise fast, asset values fall fast, quietly. Balance sheets don't scream, they erode. And when enough erosion happens, resolution frameworks matter. Not headlines, not earnings calls, legal mechanisms. The uncomfortable truth is that the system has already decided who pays first. It just hasn't needed to enforce it yet. This is where the hype breaks down. You're told banks are safer now. More capital, more regulation, more stress tests. All true. But safety doesn't mean immunity. It means predictability. And the predictable outcome, under stress, is internal absorption of losses, by design. There's a dark humor in this. For decades, savers were told to be responsible, save more, avoid risk, keep cash. And now the system quietly treats large savers as shock absorbers. Not villains, not gamblers, but tools. None of this means your bank is about to seize your savings tomorrow. That's not how these things work. They don't happen suddenly. They happen when pressure accumulates and options run out. And when that moment comes, the rules won't change. They'll be followed. Which raises the final question. If your money in the bank is legally a loan, if depositors are part of the resolution plan, if safety depends on confidence more than certainty, then what does saving actually mean in a system like this? Not what you should do, not what's right or wrong, just this. When you look at your balance, are you seeing money you own or a claim you hope will be honored when it matters most?